Welcome back to FT Markets. The year started with government bond yields from the biggest countries in the world falling to even lower levels. Japanese 5-year bond yields have hit zero, and in the UK, exceptionally low inflation has sent government borrowing costs also much lower. With me to discuss what's driving these exceptionally low borrowing costs is Joachim Fels, who's the chief economist at Morgan Stanley. Joachim, welcome. What's your explanation for these quite extraordinary developments we've seen continuing into 2015?
Yeah, it's actually quite extraordinary to see this decline in bond yields. I think what we are seeing is a combination of three fundamental factors, or as I like to call it, the three gluts.
Three gluts. Okay, what are those three gluts?
Well, there's a global savings glut, which is the underlying structural factor. There's an oil glut,
which has been with us for some years.
Correct. And there is a liquidity glut, which is driven by central banks.
Okay, the second one was the oil glut, which of course is related to the sharp fall we've seen in oil prices, which has been driving down inflation and expected inflation. In our first chart, which you brought along, you've actually shown the economic impact it has on various countries, clearly depending whether they're importing or exporting oil. What's your point here? Why is this having such a depressing effect on gilt yields and other bond yields?
Well, first of all, I think there are two effects of the oil glut. The first one is on real growth, on the real economy, on demand. And in a way, the oil glut helps to mitigate the depressing impact of the savings glut on growth. So what we're seeing is that money is beyond incomes are being redistributed from high savers to low savers, and this is why it's pushing up growth, as you can see in the chart, in all these oil importing countries.
Which should push yields higher.
Which per se should push yields higher, at least real yields. But then there's a second effect of the oil glut, and this is to push down headline inflation. And more importantly, it's led to a decline in medium and long-term inflation expectations. And I think that's the dominating factor which is depressing yields.
Okay, the third factor you mentioned was the liquidity glut, which is the stance of central banks, essentially, which is illustrated in the second chart you brought along. This is slightly complicated. You have to explain very quickly what is going on here. These are the different central banks around the world?
Yes, different central banks, emerging market central banks left of the vertical bar, developed market central banks on the right. And then we've placed them according to the stance of monetary policy. So if you're in the north, your policy is contractionary. Right. Central banks in the south have very expansionary monetary policy.
And the different colours indicates where they're likely to go next.
Yes, exactly. That shows the bias. So countries in blue or central banks in blue, like the euro area, Japan, have a bias to ease policy further.
The next steps will be cuts or QE or...
Yes.
And of course, the point being that most of the central banks, and all of them in the developed world, are in the bottom half of your chart.
Yes, that's correct. So this shows that global monetary policy is very expansionary, and there are many central banks that will ease further.
Okay, at the moment you have the US on neutral. I thought the market expectation, at least until recently, was that the Fed would hike in the middle of this year.
Yes, I think that was the December story. That this is what showed up in the press conference. This is what the minutes suggested. However, what's happened since is that inflation has fallen further. In the labor market report last Friday, we had a drop in wage growth, so there's no evidence of wages picking up. So we think over the next few months, the Fed will have to shift out and push out its rate guidance to 2016.
Okay, and the UK, you suggest, might tighten, but we've had exceptionally low inflation data. Might you change your mind on the UK?
Yeah, this color may change. So currently we think they will probably start to raise interest rates in the fourth quarter of this year at the earliest. But I think the risk is that even the UK goes later because we are seeing a global trend towards lower inflation and lower inflation expectations.
Okay, I have to ask you what's going to happen next. Our final chart just shows how, well, it's 10-year bond yields in this case in the US, Germany, Japan have continued to tumble in 2015, almost heading towards that zero level there. What's going to happen next? If you put all those factors together, presumably every reason to see that downward trend continuing.
Well, I think the key story for this year, the key macro story, is what I call the battle against lowflation. This is what central banks are fighting. They have to overcome this low inflation environment. I think the drop in inflation expectations that we've seen recently will lead to more monetary easing. If and when that happens, I think bond yields will eventually start to rise again. So it's all about central banks pushing inflation expectations higher.
Are they going to lose credibility, though?
I think they've already lost a lot of credibility. If you look at the sharp drop in inflation expectations, this is why action is required if and when we get it, I think eventually you will see them regaining credibility, inflation expectations rising, and then eventually later this year, I think these bond yields will also start to back up again.
Joachim, we have to stop there. Thank you very much. So confidence that perhaps yields might start to rise again sometime later this year, but for now, those very powerful three gluts pushing yields seemingly ever downwards.